Okay, well, I hope everyone's doing well this morning. I am Karen Smelser, and I'm an accounting tutor from the Cypress Creek campus. And if you signed up for this course today, we are going to talk about the double entry accounting basics. So this course is designed primarily for those of you who are relatively new to accounting, or maybe you're taking the second accounting course like managerial and it's been a while and you need a little refresher. So this will just touch on some of the very basics. I'm going to go ahead and present my screen now, so I won't be able to see you. But if you have any questions, send them through the chat, and we will address those at the end of the course, okay? So hopefully everyone's seeing the expanded accounting equation on their screen. The basic accounting equation is just assets equals liabilities plus equity, which you see there at the top. This expanded accounting equation breaks down those components of the equity piece. And they include those contributed capital, which is common stock. It could be paid in capital, but in the first course, you generally see common stock as the primary contributed capital. And then the retained earnings components are your revenues and your expenses, and then the dividends you pay out. Those T accounts that you see below each of those accounts, those pluses and minuses, those represent the side of the account that increases. So for instance, an asset would increase on the debit side because the debit's on the left side of that T account, but a liability would increase with a credit, which is on the right side of the T account. So this is something you're going to have to kind of commit to memory right on the front end, but this is the primary basis of all of accounting, is everything must balance, and it follows this equation. So the normal balance of an account is considered to be on the side where an increase is recorded. So as we saw on those T accounts, sometimes it's the debit side and sometimes it's the credit side. So don't think of debit as a plus and credit as a minus. That's not necessarily the case. They can be either, depending on the account you're using. So you're probably saying to yourself, how in the world am I going to ever remember all of this? As you go through accounting and use these transactions more and more, it will start to become second nature to you. But initially, of course, it is not. So there's been some acronyms that have been developed. The one that is listed, if you're taking Accounting 2301 in the Financial and Managerial Accounting book, they use this acronym, which can be helpful, but feel free to use any that help you. This is the one they use, and it's called All Elephants Do Love Rowdy Children. If you can remember that phrase, it helps you remember which type of accounts have normal debit or credit balances. So in this one, the A is assets, E is expenses, and D is dividends. And their normal debit balance, they have a normal debit balance. The L is for liabilities, the R is for revenue, and the C is for common stock, and they all have normal credit balances. Okay, it's not necessarily intuitive to know this, but I tell a lot of my students that it's sort of like learning a programming language. Once you learn the language, there is logic to it, and you will start to understand it. But at the front end, you'll have to just start to kind of memorize these debits and credits and these accounts until it does become second nature to you. The key to accounting, or everything revolves around the debits must equal the credits. So as we post our transactions, every accounting entry must have a total debit and a total credit that is the same amount. And once you've got all your accounts posted to your ledgers, your trial balance, anything, those totals will always need to match. So it's always a good check to make sure, at a minimum, you have a total debits that equals total credits. Some of the common account types, this is not an all-inclusive list by any means, but these are ones you'll often see, particularly in the first accounting courses, are listed on your screen in front of you. So we've talked about account types, and you need to know whether they're increase on the debit or credit side. And these are some of the accounts under those account types. So for instance, assets, we have in this screen cash, accounts receivable, prepaid expenses, inventory, property, plant, and equipment. Liabilities, you'll often see accounts payable, unearned revenue, and notes payable. And then equity, common stock, and then revenue and expenses. And those, of course, have a lot of accounts underneath them, but we won't talk about that in too much detail in this class, but all your income and expenses are in there. So then when we go to record journal entries, we run through these 3 steps. The first would be we have to identify the accounts that we need to use to make this journal entry, and we need the account types for those transactions, because we need to understand the account types to know whether we're increasing a liability, increasing an asset, so we know whether to debit or credit those accounts. And then finally, of course, you will record this journal entry. So let's run through some practice transactions. Okay. On the screen, you should see on June 1st, Practice Company received $50,000 of cash from John Doe, and the company issued stock to him. So take a minute and think about which accounts we need to use for this transaction, what type of account they would be, and which accounts you would debit and which you would credit. Okay. So on this screen, you should see the actual journal entry and the T accounts. So I just repeated the question on the top, but the journal entry, we have a date of June 1st here, and because we are receiving cash, we're increasing that asset. And if you remember back from about my second screen, to increase an asset, we need to debit that account. So we're going to debit our cash account for $50,000, and we are going to issue stock to John Doe, and common stock's an equity account. Okay, so we're going to credit that account. And then, always good to remember, you should always write a brief description below any journal entry you make. So I've written to issue common stock to John Doe. And then the next step, and this will go further, but I'm not going to go through the whole accounting cycle with you today. But in the T account, you will see the debit of $50,000 and the credit on the common stock side of $50,000. Okay. So how did you do on that one? The next one we'll try is transaction number 2 that you should see on your screen. On August 15th, Practice Company purchased equipment for $10,000 cash. So again, think about this for a minute and think about what accounts we would need to use to record this journal entry. Okay, we're purchasing equipment, so that's probably a good clue that we have some sort of a property, plant, equipment type account, right? And we're spending cash, so we're likely going to affect that cash account. Okay, so on this next screen, you'll see that the entry would be to debit your equipment account for $10,000, and that's because we're purchasing equipment. Equipment is an asset, and to increase an asset, we always make a debit entry. We're spending our cash, which is also an asset, and to decrease an asset account, we are going to credit that account. So we make a credit entry. Of course, we write our description there to record the purchase of equipment. And I have added these transactions to the T accounts for this company below. Okay. Let's try a third transaction. On August 31st, Practice Company paid cash expenses of $2,500 in salaries and $1,000 in advertising. Now think about this one. This transaction may have more than just 2 accounts involved. And in fact, any journal entry could. The previous 2 that we practiced only had 2. But if you dissect this transaction, we see first they paid cash, so we're probably going to affect that cash account. We are paying salaries, and we are also paying advertising. So we can record this, and if we record it with more than one debit and one credit to each account, they are called compound entries. So this would be considered a compound entry. So first we're going to debit our salaries expense for $2,500. Expense accounts are a type of equity account, but expense accounts are always increased with a debit. Okay, so you see that we've debited the expense $2,500. Advertising expense also is an expense, which gives you a pretty good clue when it's part of the name. And it also would be increased with a debit. So its debit is $1,000. And then we're paying cash. Again, that's an asset account we're decreasing. And so we need to credit that account for the $3,500 in cash that we paid. Okay. Again, these are cash expenses. Below that, I've gone ahead and added this third transaction to our T accounts for our company. Okay. We're just going to keep, and during the period, I'll just mention those accounts, every transaction would run through those accounts. Now, of course, you're usually using software when you're in real practice, but every single transaction is going to end up in those accounts for the period. Okay, our final transaction we're going to practice today is number 4, which you should see on your screen. And that one says, on November 30th, practice company collected cash of $7,000 for services performed. Okay. So this one, I only see 2 accounts mentioned probably, right? We're receiving cash and we're paying for and we perform services, I'm sorry. Okay. So to record this entry, we're going to actually increase our asset account, which is cash, by $7,000 because they paid us that money. And then the service revenue, when you increase a revenue account, that's actually a credit entry. That is probably one of the most common accounts I see incorrectly recorded. It may seem a little counterintuitive to have income increase with a credit, but that is how it works in the accounting, the double entry accounting system. So just be careful with that. So we're going to record $7,000 because we perform some service and we can record that as income. Okay. Again, I've put the description below that, and I've added this final transaction to our T accounts. Okay. So obviously, if you had it at a company, you would likely have many, many more transactions than these 4. But just for time and to simplify this, we're going to say these are all the transactions we have for our company for this period. Okay. So here you'll see our totals of all our T accounts. And what you will do is you will come up with a net balance, either debit or credit, for each of these type of accounts. So you'll see that in cash, I've taken the $57,000 in debits and I've subtracted the $13,500 in credits, and I've come up with a net of $43,500. And I've done that for each account. And then you'll want to make a final check and make sure your total debits for all your accounts are have the same total as your total credits for all your accounts. And if you add these up, they should total $57,000 each, the debits and the credits. When you're working a problem or a lab or even on a test, just one way to really catch a mistake sometimes is to check that your balances do total. You might find you made an entry on a wrong side or something very easily if you don't match. So I just would encourage you to always double check that. Okay, Well, that was a very quick, short course on debits and credits and account types, but I'm going to give you a little quiz here. So if you would just jot down in front of you the answers to these. There's only about 5, but I'll read them, and then if you'll write down the answers, and we'll go through them at the end and on the next couple of screens. So number 1 is accounts payable is what type of an account? Is it an asset, a liability, an equity, or an expense? Okay. The next one, we have a revenue account is increased with a credit or a debit. Okay, and then the third one, the basic accounting equation is assets plus liabilities equals equity. Assets equals liabilities plus equity. Assets equals liabilities plus common stock plus revenues minus expenses. Or D, assets equals liabilities plus common stock minus dividends plus revenues minus expenses. It's a mouthful. Select the correct one for that. And the last 2, the normal balance of an expense account is either a credit or a debit. And the normal balance, remember, is the side which increases the account. And that, of course, depends on the account type. And then finally, the normal balance of an account is on the debit side, the side which decreases an account, the side which increases, and pardon my typo there, an account, it should say, or the credit side. Okay, so let's see how we did. Here are our answers. So the first one, the accounts payable is a liability account. So hopefully you chose B. The second one, a revenue account is increased with, and it is increased with a credit. And I pointed that out in that one example we had, because that's a commonly missed transaction. The third one, the basic accounting equation is just assets equals liabilities plus equity. Remember the first screen, that includes the common stock, the revenues, expenses, that's the expanded accounting equation. So if you chose that one, you chose the expanded, but the basic one is assets equals liabilities plus equity. Okay. Number 4, the normal balance of an expense account is on the debit side. Okay, so hopefully that you got correct, and we had that in one of our examples we just worked through. And finally, the normal balance of an account is the side which increases an account. So I appreciate you joining us today, and again, I hope this was helpful, and I hope to hear from some of you again.